Today is Monday, April 9th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's start with the grains this morning. Funds are buying back soybeans, soy meal, corn, and covering wheat shorts. Why?
I think it's a combination, first in corn and wheat, that we're looking at a weather situation in the United States. It's too cold to plant, and parts of the western southern plains is dry, and then we also have some issues in South America where the corn crop could be smaller than what the trade had thought. Over the beans, it's strictly demand, and the meal market is about ready to break out and make new contract highs on this demand scenario, and the beans are trying to filter through all this trade wars and things like that, but we continue to see higher trade in beans because of demand.
You mentioned weather. Let's jump to weather. Weather coming more to the forefront here in the U.S. right now as we approach the planting season. Is the weather ever going to improve here?
Well, in talking to our weather guy this morning, he said, first of all, the cold weather has been colder and lasting more than expected. And he thinks that the jet stream will eventually move further north and allow for plantings, but it may be later in the month of April than what he had thought. The other thing is that we are in a situation where we have a solar minimum, and what that means is that potentially June, July, and August temperatures across the Midwest could be colder than normal. There's no statistical reason to think this, but in some of those years we've actually had early freezes.
You talked about meal approaching some resistance levels. Can you cover the technicals in corn, soybeans, and wheat a little?
Well, soybeans and soybean meal are near season highs, and fundamentally it's causing a lot of concern amongst analysts because there's no reason for us to be at these price levels because we have too much supply. You're going to have a record Brazil crop. We have big stocks here in the United States, and then we have all these trade issues. But the funds still like buying because of the meal demand. And when we look at the lower Argentina crop, we actually could be tight in meal until next year when Argentina grows their next crop. So we look for strong resistance in the beans at 1050. We don't really need to trade much higher than that. And if we have good crops, the November contract, it might be worth 850. Now in corn, we're beginning to look at getting back into a trading range that we were last year before we had the record yield. And I think that $4 to $4.20 range is probably a comfortable range for July corn. I don't think we need to trade over that because there's just too much corn here in the United States for the farmers still to sell. And wheat is actually getting back into that same range, mostly because it looks like now we're not going to be able to plant the spring wheat on a timely basis.
Steve, later this week we have USDA supply and demand report. Any thoughts on what they'll say?
It should be a little negative report. From the March stocks report, they should lower the residuals in corn, beans, and wheat and raise the carryout. We think the USDA is going to be conservative in the bean S&D because they just don't know what's going to happen as far as trade wars are concerned. We hope that non-China buyers of Brazil beans come in and buy our beans now because we're the cheaper than Brazil. Brazil has rallied a lot in their prices when they heard that China may not buy from the U.S. and may need to buy more from Brazil. So all in all, we look for this report to be just a little negative. In May is when the USDA comes out with their first 18 and 19 supply demands, and those actually could be a little more positive.
So you talk a little bit about China and the trade tariff, talks recently that have been in the news. How does that affect U.S. agriculture overall? I know that it's hard to get a beat on what's going on with the soybeans, as you mentioned.
Well, I think there's three things. Number one, trade wars are not bullish, and we hope, like today, beans are up because they hope that there could be an easing of the tension between the two countries and they became some kind of resolution versus putting on these tariffs. Number two is they're getting a lot of backlash from agriculture. Farmers are concerned that this is going to cut into their revenue, and the president has said that he will do something with the farm bill potentially to help with the farmers if there are some trade issues, but the farmers really aren't buying that, and they're concerned about their revenue. And I think that's kind of an important thing, because some of the tariffs that the Chinese have imposed or could impose on the United States is all the president's voting base, the people that have got him elected for president. So the number 3 thing is that you could start seeing some long-term changes. If Brazil wants to ramp up production and improve logistics, we could see a lower bean exports from the United States to China down the road, even without tariffs. So there could be some long-term implications on U.S. soybean production and exports if Brazil can increase their production and their logistics.
We'll continue to follow this story as it develops over the next few weeks.
It changes every day.
Alan, turning to the financials, on Friday it was reported that U.S. non-farm payrolls increased 103,000 in March when economists had expected 178,000 new jobs. How does this affect Fed policy?
It appears that it has not affected it at all as far as the outlook, even though the non-farm payrolls was a bit on the weak side. In fact, the probability of a rate increase at the June meeting now, as of today, moved up to 85% according to the financial futures markets. And on Friday, it was 78%. So I have to still be on track for a total of 3 rate hikes this year. That seems to be the consensus view. So nothing has really changed. A rate hike likely in June, and a total of 3 for this year seems to be what we are in store for.
Alan, the stock market continues to be very volatile. Is this the new normal? And also, the trade tensions have done some damage to the bull market. Have stock index futures topped?
Well, I think Steve said it best when you said that trade wars are not bullish. Well, that is basically the same for financial markets as well. The stock indices have obviously come under some pressure with all of this trade war rhetoric. Ultimately, these issues will get resolved. The question is when, but when they are on the back burner or resolved to one degree or another, other fundamentals will take over, which will probably be the dominant interest rate influence, which still is a bullish factor. In fact, global interest rates are at this point still very low, very accommodative as far as central bank policy. And once that dominant influence takes over again, we will see some higher prices again for the stock index futures.
What about the volatility, Alan? You know, we're seeing, 200 to 600, 700 point swings in the Dow Jones, on a daily basis. Is this something that we can expect to last for some time to come?
Absolutely. I think there is going to be a tendency for the volatility to remain with us as these trade tensions remain. And keep in mind that it's the political markets that are the most difficult to trade, because one never knows what politician, what country is going to say what at any particular time. So caution is the name of the game right now. I would think this is a very good time to scale down numbers, try to reduce risk, because the volatility, I believe, is going to remain for quite some time.
Historically, precious metals have advanced during times of uncertainty, times of volatility. Gold continues to be in a congestion pattern. What's the story with the precious metals, and which way do you think the gold, particularly the gold, will go when it breaks out of this congestion area?
Well, normally when the trade issues heat up, we see the gold advance, and when there's somewhat of an easing of tensions, as there appears to be today, the gold would normally come under some pressure. Although gold actually is performing well today, it's a little bit higher. Also, the rule of thumb is that in congestion patterns, in fact this applies to all markets, that futures will normally break out of a congestion pattern in the same direction that they came into the pattern. In this case, in the gold, it was to the upside. So I think ultimately we will see a breakout higher in the gold market. Inflation is likely to come back. So the fundamentals have really not changed at all. The gold market is still in a bullish mode, and higher prices are likely.
All right, thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.